Lots of information swirling around the news right now, and there's no doubt it's going to have an effect on the housing market. If you want to know how, stay tuned because I'm going to get into it right now. Hey everybody, Dietric Williams, realtor with Compass, Baldwin Hills, California, and welcome to another edition of Info on the Go, the show where I give tips, tricks, and insight on how to buy, sell, or invest in real estate the easy way. If that sounds like something that you're interested in, please make sure you hit that subscribe button and ring that bell so that you're notified every time I upload new content to YouTube. Now, you've undoubtedly heard inflation, wars, and the Fed spiraling through the news the past month or so. And there's a great reason that this is important, especially as it relates to those of you who may be interested in buying or selling a home. So let's talk about inflation first. What really is inflation? That's essentially just how prices change over the course of time. So you've probably seen this, and no doubt I've seen it, that we're paying more for things like bread, gas, butter, clothes, the whole 9 yards. Prices have continued to increase. Now, historically, the Fed has kind of curtailed inflation somewhere to hover around 2% annually over the last, 20 plus years or so. Today, that rate is at about 8%. So yes, we're feeling the crunch. Normally, inflation causes investors to get a little bit skittish, and they start pulling their money out of the stock market and putting it into things like 10-year treasury notes or bonds. And what makes these instruments really attractive is that investors know that once the bond matures, they're going to get all their money back plus a rate of return in the form of interest. Now, the interest rate on these notes is changed by the Fed twice a year. I want to say it changes in May and November are around the times that they change the rates on these bonds. Now, keep in mind that the interest rate on these fluctuates constantly all the time, depending on supply and demand and what's happening in the market. But just to give you a gist, again, investors pull money out of the stock market and they invest in bonds because it's a safer risk. If investors are unwilling to spend money on these bonds, that drives the price for these bonds down and conversely drives the interest rate up. Now, the interest rate on the 10-year treasury note has a direct correlation to 15 and 30-year fixed mortgage rates. And we've seen this play out the last several weeks as the stock market has been extremely volatile with its ups and downs. You have the issue that's going on between Russia and the Ukraine, which is also causing investors to be a little bit skittish toward the stock market and begin to pull out. Not to mention, we're talking about that dreaded I word that I mentioned earlier, inflation. Now, inflation is the arch enemy of bonds, and that's because as inflation increases, it erodes the return on the investment that you can get for buying a bond. So let me give you an example. Suppose I buy a $1,000 treasury note. It's going to mature in 10 years. So I know I'm going to get my $1,000 back. But let's say the interest rate on that is 4%, which usually gets paid out semi-annually or annually. Now, if inflation is at 8%, and I'm just taking that for today's inflation rate, usually it's the annual inflation rate, but I'm just going to use this as an example. So if inflation is 8% and my bond is paying me 4%, essentially I'm losing money. So in order for those bonds to be attractive, the interest rate on the bond has to increase to offset what is going on with inflation. So if inflation is at 8%, as an investor, I probably want a bond that's paying 10% because I know that 8% is going to get eaten by inflation and I want a 2% return in the net. So that's kind of what goes on. Now I'm giving you, again, just kind of a roundabout way that this happens, but now you get the gist of it. Even aside from inflation, let's just say that the bond that I purchased, which yields 4%, in 6 months now only yields 3.5%. Well, what investor is going to want to pay $1,000 for that bond at 3.5% when they can get mine at 4%? They wouldn't. And this is why people are keeping such tight tabs on inflation, the war, and the Fed. Now, the Fed is going to have their Federal Open Market Committee meeting on March the 15th and the 16th. And there's two levers that they can normally pull to kind of curtail inflation. One is to change the benchmark of the Fed funds rate. The other is to unload some of the things that are on its balance sheet. Now, the Fed funds rate is the interest rate that is charged to banks for overnight borrowing. And why did they do this? Well, the Fed tells every bank that you need to have a certain amount of reserves on hand at the close of business, so that if somebody comes in the next day and decides to pull out like exorbitant amounts of cash, you're not caught basically with your pants down. So at the end of the day, well, let me back up. When you go deposit your money at a bank, and I hope you know this, it doesn't just sit in some box with your name on it. The bank takes your money and then they go out and they lend it. So there's not this big exorbitant amount of cash that's sitting at the bank. Well, the Fed says in order for you to not get caught slipping, we need you to have reserves on hand. So what happens is, let's say that the bank gets $1 million in deposits that day, but they loan out, let's say, 900,000 of it, which means they only have $100,000 left. And somebody can easily come in and claim that. So the Fed says you need to have reserve requirements. So they have to go to another bank who may have more than what they need in reserves, and they don't want to keep that in their ledgers. So they will lend to another bank at a rate of return that is equal to the Fed funds rate. So the next morning, the bank will pay the other bank back, and they'll charge them interest on the money that's borrowed overnight. So now you know how the Fed funds rate works. This rate doesn't really affect mortgages directly per se. Not, at least not the 15 and the 30-year mortgage. Now, if you have an adjustable rate mortgage, that rate is directly correlated to the Fed funds rate. The Fed funds rate also relates to interest that's charged on credit cards. So if you have a high balance, outstanding balance on your credit card, you may want to look at paying that off, or at least down significantly, before the Fed meets in a couple of weeks and may raise that Fed funds rate up, which will affect you as a borrower for an adjustable rate mortgage or somebody who's borrowed for their credit card. Now, hiking up the Fed funds rate may be good for mortgage rates. And the reason is because as the Fed does this to curb inflation, it helps hedge against some of the erosion that happens with the interest rate on those bonds that are directly tied to mortgage rates. So this is why we just want to make sure that we're paying close attention to it. Another thing the Fed could do is reduce some of the things that are on its balance sheet. So several videos ago, I don't even remember how far back, but I talked about during the pandemic, the Fed was acquiring mortgage-backed securities and treasury notes, basically from themselves or whatnot. And that was taking those instruments of investment out of the market and infusing the market with cash, which helped to kind of keep the economy afloat while we were trying to figure everything out. Now things are getting back to some sort of normalcy with the jobs reports being better. I believe at one point there were 20 million Americans who were claiming unemployment benefits. Now that number's down to 2. There were approximately 5 million people in forbearance. That number has dropped significantly. So the Fed is looking at all these things because we are in somewhat of a healthy economy. Now, what they're going to do is really uncertain at this time, but if the Fed were to sell off some of those bonds, it would essentially flood the market with an increased supply. That increased supply would make interest rates shoot up for bonds, and conversely, shoot up for mortgages. So what they're going to do, again, nobody quite knows, because there's a little bit of, I'll call it turmoil, just to kind of create some fodder, right? So there's some uncertainty between Fed members as what's the best course of action to take. I think they're probably leaning more toward raising the Fed funds rate, and I want to say like 1/4 point, something like that, or maybe essentially 1/4%. So it's going to be really interesting to see what happens when they meet in mid-March. Now, all of this could be a good thing for the housing market, depending on how you're looking at it. With housing prices expected to increase and mortgage rates increasing, that is going to cause some buyers to pull out of the market, which will soften some of that demand that's out there. The goal, I believe, for our industry is to bring some sort of equilibrium or parity. So getting those numbers down to equal or equate to about what's happening with inventory. Right now, we don't have a lot of inventory. We have a ton of buyers who are out there. So if inventory remains the same, but buyers drop down, that will help bring us back into a stable market. We'll see some price cooling. And it could mean that more people decide it's time to try to purchase a home again. But we'll see what happens, because as that happens, if inventory doesn't increase, you'll see people coming back into the market trying to get in. But again, affordability might be an issue, because if prices go up and interest rates go up, it's going to put some people out of the market altogether. They just won't have a choice but to jump out. Now, if we can get back down to equilibrium, that'll soften prices up. And as it continues to go, we'll see prices begin to decelerate. When that happens, I don't know, but for the remainder of this year, analysts are expecting prices to go up and interest rates to go up too. Now, with the whole thing with inflation, what's happening with Russia and the Ukraine, and even the Fed's decision, these are going to be some very interesting times. So if you are out looking to purchase a home and you have gotten pre-approved recently, you may be thinking, or you're thinking about getting pre-approved like right now. You may see interest rates have dropped because of what's going on in the market, to decide, hey, we're gonna buy a house now. So that interest rate that you're seeing is just a snapshot in time, today's time. So if you got quoted at 3.75% right now, you probably don't want to expect that to be the rate that you're gonna pay if you haven't gone into escrow just yet. And the reason is because when you get into escrow and you're getting ready to close, a few days prior to that, or maybe a week prior to that, the lender will say, hey, do you want to lock in your rate? By the way, your rate is X. And it could be drastically different from the rate that they kind of quoted you on when you got your pre-approval. And that's because, again, it's just a snapshot in time. So don't bank on the interest rate you see on your pre-approval being the rate that you close on when you actually get the house. So you just want to keep an eye out for that, because a difference in a half a point could mean the difference between you being able to afford the house and you eating top ramen for the next 2 to 3 years. Additionally, ask your lender if they do anything called a free float down. And what a free float down is if you were quoted at 4% and the rate drops to like 3.75 just before you close or when you lock, if your lender offers a free float down, they will give you the 3.75% at no additional charge. So you just want to ask your lender about that, because that could be something that you take advantage of. Now, as with everything, you just want to continue to watch the market, see what happens. Now, don't get caught up in all the hype that the news presents. Get the data, get the facts, and then you can make an informed decision. If you are looking to purchase a house and you're kind of worried about what's going on with inflation and the war and just what the Fed is going to do, and you may be a little bit uncertain about how much money it's going to take you to be able to close and put a down payment on that house, there are some programs that are out there. So watch these 2 videos I did on various down payment assistance programs, and they could potentially help you save thousands, if not tens of thousands of dollars.